Welcome to the SchiffGold Friday Gold Wrap, and I'm your host, Peter Schiff. Now, regular listeners to this podcast are not accustomed to my doing it myself. The reason I am doing it myself today is because the guy that used to do it doesn't work for SchiffGold anymore, as you may or may not know. In fact, that's why we haven't had a SchiffGold Friday Wrap in a couple of weeks, because there hasn't been anybody here to do it. Well, I decided to do it myself. I'm not really sure what's going to happen to the Friday market wrap, whether I'll continue it or not, whether I'll have another SchiffGold representative do it. Maybe I'll just do it myself. I'm not 100% sure yet, but I wanted to reach out today just in case some people were wondering what happened to it. Well, now you know. But I may do it myself. But if I do, I'm probably not going to start doing it on a regular basis until mid-August, because in less than 2 weeks, I'm leaving for my annual summer vacation. My kids are out of school, and so we do a lot of traveling. We're back in the States, and I really don't do much work over the summer. I do my work when I'm here in Puerto Rico, so I won't do these podcasts then, although I do continue on a limited basis my regular podcast. And in fact, if some of you only listen to the Gold Wrap and don't realize that I have the Peter Schiff Show podcast that I do on my channel, my YouTube channel, tune into that, because of course I do talk about gold and silver on that podcast as well. Not exclusively. It's a lot more of a broader podcast. I go over economics and politics, but I certainly talk about the precious metals. But I like the idea of having this weekly kind of exclusive rundown of what happened in gold and silver. So I very well may continue the tradition at SchiffGold and do it myself. But again, not until I'm done with the summer vacation. But for now, let's talk about what happened during the week in gold and silver. It was a down week. Gold prices dropped about 4%, which is a pretty big drop. But considering how much gold had gone up, not unusual. I mean, nothing moves in a straight line. And gold volatility has picked up recently, both on the upside and now on the downside. So gold settled the week just above 3,200, 3,202 approximately. I think there's a lot of support around this level. I think anything below 3,200, I think you're buying near the bottom. In fact, I think 3,000 is the new 2,000. If you recall, when gold was around 2,000, when it initially broke out earlier last year, I was encouraging clients of SchiffGold to buy that breakout. I said 2,000 was the new floor for gold, and it turned out that that was the case. And people who bought, in the low 2,000s, 2,100, 2,200, are in a very good position now with gold $1,000 an ounce higher. Yes, gold did almost hit 3,500. That was a few weeks ago. That is not going to be the high for this bull market. I think years from now, you won't even notice this little bit of a correction. And 3,500 will be much lower in the rearview mirror than where we're going. So that's just a stop in a much bigger bull market. Silver prices also declined on the week, not quite as much as gold. Of course, silver didn't go up nearly as much as gold. So silver was down about 1.7%, closed around $32.26, something like that. Gold is up about, I think, 40% since the summer of 2024, June, July timeframe. Silver is up less than 10% during the same period of time. In fact, I think when gold broke 2,000, silver was, maybe $28 or something like that. And I remember when silver broke above 30, I said that, well, $30 silver was like $2,000 gold, meaning that you were buying the bottom, because I didn't really expect silver prices to go back below 30. And if they did, I didn't think they'd stay there for any significant amount of time. Well, I still think that's the case. The difference is you could still buy silver very close to the floor at 32. In fact, buying silver today, it's almost like turning back the clock to when gold was at 2000, because we're not much higher now in the price of silver. In fact, the gold silver ratio is about 100 to 1. You can get 100 ounces of silver for every 1 ounce of gold. That is a ridiculously low price for silver. I think we almost got to 110 when gold had, spiked up to close to 3,500. That may be the record low for silver. We'll see. I mean, this has been a big bear market in silver when you price it in gold, which is real money. But I think that if this bear market has finally bottomed, we have tremendous upside in the price of silver. And so if you missed out on $2,000 gold, well, you're in luck, because you could still buy $32 silver, which I think is a similar entry point. And the main reason that gold has been so much stronger than silver is because the main drivers have been central banks. Central banks have been buying lots of gold. They just don't buy silver. They don't have the place to store it. It's not their reserve asset. Gold is the money for central bankers, not silver. Silver is more the people's money. And the people haven't been buying, but the central banks have. And if you're smart, you'll follow the bankers, because they're really the insiders. It's like when the management is buying stock of a company, it's generally a good sign, because they're the closest to the company, and they're buying. So they must know something. They have some confidence. Well, the central bankers are the insiders of the global fiat monetary system, and they're buying gold. And that means they're selling dollars. And so in that sense, it's like the insiders dumping their stock. And if insiders are selling their stock, well, maybe you should sell yours too, because they might know something that you don't. And I think what the central bankers know that a lot of people don't know is that the dollar's days as the world's reserve currency are numbered. And that number may not be very large. And so they've been moving out of dollars, and that accelerated on Liberation Day. And that's why we got that big spike in the price of gold. And that's why we've had a pullback, because over the last couple of weeks, Donald Trump has basically walked all that back and surrendered in the trade war. First, he surrendered against the world and rolled back all the reciprocal tariffs with a 90-day pause, which, is probably going to be permanent, I guess. But he left the reciprocal tariffs on China, and he finally surrendered on that front as well by rolling those back with another so-called 90-day pause. Although I think today or the other day, Donald Trump mentioned now that he's actually not going to be entering into all these negotiations for new trade deals. He's just going to be sending out memos to let each country know what the tariff is going to be with respect to that country. And I believe that the rates are going to be far lower than the reciprocal rates that correctly, scared people into selling stocks and buying gold. Because I think the institutional investors, when they saw what Trump, unveiled, and the markets reacted, the stock market, the bond market, the dollar, we finally saw some institutional movement into gold, which accelerated a trend that was already in motion, because now you had some private demand competing with the government demand, the central banks, and even some retail buying. Not a lot. I think it was more some of the institutional buyers that went into gold, not so much the individual. I mean, we saw a bit of a pickup at SchiffGold, but nothing really substantial, not like we did, back in the COVID days when we saw a real retail rush into gold. We didn't see that post-Liberation Day, but we did see some institutional money moving in. And of course, the central banks probably stepped it up a bit, and we got that spike. But now that everything is de-escalated, we've had a pullback in the price of gold, along with a big rise in the stock market. In fact, the stock market in the U.S., which pretty much went into a bear market following Liberation Day, now that we've canceled Liberation Day, the stock market has recovered everything that it lost. And so as you've had investors now re-embracing risk assets, they sold the safe havens. And so people who rushed into gold because they were worried are now selling their gold because they're not worried anymore, and they're buying stocks. But all of the fundamentals that were driving the price of gold higher before Liberation Day are going to continue to drive it higher, even though we're no longer liberated, even though we've canceled all those reciprocal tariffs. And I think the markets are going to start to turn their attention to other issues that are going to be very bullish for gold, meaning the deficit. Because one of the, campaign promises of Trump was to cut government spending, to pay down the debt. And a lot of people believe that, especially when we had the introduction of Doge with Elon Musk, and they were coming out with all these announcements of big cuts in waste, fraud, and abuse. Well, I think most of the Doge cuts have been made, and the reality is it doesn't amount to anything significant when you compare it to the overwhelming size of the federal budget and the spending increases that are in the pipeline that are going to dwarf whatever Doge managed to cut. But not only is the Republican Congress debating how much more money the government is going to spend, they're also cutting taxes. And they're not raising taxes on anybody, not even the millionaires or the billionaires. They're cutting taxes across the board, and they're increasing government spending. So the budget deficits that Trump inherited from Biden are going to be bigger, not smaller. We're going to have larger deficits, and we're going to have even more pressure on the Fed to monetize those deficits, not just with rate cuts that are eventually going to come, but with a return to quantitative easing. And that's why I think the bond market did not recover along with the stock market. That's why yields on a 10-year treasury are still close to 4.5, and on a 30-year close to 5. And the market looks like it's going to break down. And even if the Fed comes in with some rate cuts later in the year, that's not going to bring down long-term rates. If anything, that will push them even higher, because you have a movement out of U.S. dollars and out of U.S. treasuries. And I think that by calling attention to the problems with our trade imbalances and threatening the world with these high tariffs, I think this is a bigger, wake-up call to foreign holders of dollars, to our trading partners that have large surpluses with the United States and who have been investing those surpluses in U.S. treasuries and mortgage-backed securities and other U.S. dollar-denominated assets, that they are at risk because the United States doesn't like this. We somehow view this as being the world ripping us off, taking advantage of us. And Trump is determined to do something about these massive imbalances, which in and of themselves are not the problem. They are the consequence of the problem. And the only way to solve or get rid of the consequences is to actually solve the problem. But what Trump was looking at doing was covering up the symptoms and blaming our trading partners for a problem that we created. But I think this is the type of wake-up call that Biden sent when he put the sanctions on Russia. He let foreign central banks know and foreign governments know that it's dangerous to hold a lot of U.S. dollar reserves because we could sanction you if we don't like what you're doing. Well, now we've told them again that it's dangerous because we don't like you accumulating dollars because we're going to retaliate with tariffs, or who knows, we may even selectively default on debt held by foreigners because you've accumulated this debt unfairly. You've taken advantage of the United States. You've ripped off the United States. And so I think the de-dollarization trend that began under Biden is going to accelerate under Trump. And in fact, if we're not going to have very high tariffs, if we're just going to have low tariffs that will fill the government coffers with some extra tariff revenue, not nearly enough to offset the enormity of the tax cuts in the big, beautiful bill, and also not enough to bring any manufacturing back to the United States because Americans will just pay the tariffs, and they may consume a bit less because of the higher prices. But I think that the only way that we're going to have a significant reduction in our trade deficit is through a significant depreciation of the dollar, because that will act like a tariff, except without the benefit of the government getting any tax revenue. But if the dollar goes down dramatically, not just, a small decline, but if we have a big decline in the dollar, then all of our imports are going to be much more expensive, just as if there had been a tariff. And if our imports become a lot more expensive, well, Americans aren't going to buy as many imports. But what that means is that the dollars that we used to send abroad to pay for those imports are going to stay in the United States, bidding up consumer good prices. Because now, if we're not going to send our dollars to China or some other place, they're staying here. And what are Americans going to do? We're going to spend them. Well, so whatever we spend them on, the price is going to go up. We've benefited for the last several decades of exporting our inflation. But Trump has made it clear that that's no longer acceptable because that's foreigners taking advantage of us. So if we're going to have to keep our inflation, then we're going to see much bigger price increases than what we've been accustomed to over the years where we were exporting our inflation. But the other benefit that we're going to lose is those dollars are not going to be recycled back into the U.S. economy through the financial markets. So the dollars that Americans were using to buy foreign goods were coming back, but into our bond market, into our stock market, into our real estate market. So pushing up asset prices. So that's one way that the inflation that the Federal Reserve was creating was being routed into financial assets. And so it was the price of stocks, bonds, and real estate that went up. And that made Americans feel richer as they continued to consume low-cost goods produced by our trading partners. Well, now Americans are going to have to spend their dollars here bidding up consumer prices, and now foreigners are not going to be investing the dollars they earn bidding up our financial asset prices. In fact, I think foreigners are going to be pulling money out of U.S. stocks and bonds and investing in their own markets, especially if the dollar continues to weaken and we effectively have a weak dollar policy. We're telling the world that if you hold U.S. assets, you're going to lose because you're going to lose on the foreign exchange. One of the reasons that U.S. assets have been so attractive over the past several years was the strength of the dollar. And so the foreign currency gains augmented the gains on U.S. stocks and bonds. But now, with that reversing, the headwind of a weak dollar is going to subtract from the returns that foreigners might have on U.S. assets. And in fact, if U.S. assets start to fall, if the U.S. stock market goes into a bear market and stock prices go down, and at the same time the dollar is going down, then that augments the losses that international investors are suffering when they're measuring their returns in their own currency. So I think you're going to see a lot of selling of U.S. financial assets, and central banks are going to continue to sell dollars and U.S. treasuries, and they're going to put more and more money into gold. And that's why this trend is not only going to continue, it's going to accelerate and eventually spill over into silver as individual investors join central banks in looking for alternatives to the U.S. dollar. And the best alternative, the most viable alternative, is gold and silver. Central banks have already come to that conclusion, and they're buying gold because they have to buy a lot, and silver doesn't really suit their purpose the way gold does. But individual investors, the customers of SchiffGold, a lot of our customers, they can put money into silver. They don't have millions and millions of dollars or billions of dollars that they need to get rid of and convert to real money. If you're just talking about tens of thousands of dollars, well, you could easily take advantage of the low price in silver and convert your fiat currency into real money in the form of silver. Now, I wouldn't exclusively buy silver. I would also buy some gold, but don't forget about silver and don't think, hey, silver hasn't gone up, so it's never going to go up. It's eventually going to make a huge move and catch up to the price of gold. So in the meantime, I would take advantage. The team is still there at SchiffGold to take your orders over the weekend. You can go online and you can fill up a shopping cart with gold and silver. I think you want to take advantage of the pullback that we had this week because I think it is a gift. I think we're near the lows. I don't expect gold to go back below 3,000, just like I didn't expect it to go below 2,000. But I think anything below 3,200 is a great buy. But even if you have to pay a little bit more than that, in the scheme of things, it's still good. But I think the best buy is silver. And, it's like turning back the clock. It is a gift. I mean, if somebody would have told me, a year ago that we would be at $3,200 gold and that silver would only be $32 an ounce, I wouldn't have believed it, right? But it happened. And I think it's a gift horse. And they say not to look those in the mouth, just take advantage of the gift and be thankful that you have it. So load up on silver and do that as soon as you can. You will not regret it. I think there's very little downside, again, $30, but the upside is enormous. Not just 50, which is the double top going back to 1980. I mean, it's hard to find a commodity that you could buy cheaper than it was in 1980, but that was also the high in 2011. But I think one day $50 is going to be the floor, and we're going to head much higher. So $100 to me is a very realistic target for the price of silver, and that's a triple where it is right now. For gold, a triple, you're almost at $10,000 gold. Not that gold's not going to get to 10,000, but to me, it seems that silver will hit 100 before gold hits 10,000. And so that's why I think that you definitely want to be buying silver. Anyway, that's it for today's Friday gold market wrap. I might do another one next Friday. We don't know. You'll have to tune in to the SchiffGold YouTube channel to find out. So bye for now.